Did you know that by investing just $5 a day, less than the price of a Starbucks coffee, you could build over $300,000 in 30 years? Sounds unbelievable, right? But it's true. That's the magic of investing and compound interest. And here's the best part: you don't need to be rich, you don't need thousands of dollars sitting in your bank account, and you definitely don't need to wait for some perfect moment. In fact, you can start right now, with just a few dollars, and that small habit could turn into a massive fortune in the future. In today's video, I'm going to show you exactly how to start investing in US stocks with a small amount of money. I'll share why you should invest, the basic steps to get prepared, different strategies you can use even with tiny amounts of capital, real examples of the power of compounding, common mistakes to avoid, advanced strategies to level up, and finally, an inspiring real-life story that proves starting small is not something to be ashamed of. It's actually the secret weapon to getting ahead. Part 1: Why invest in US stocks? Let's start with the big question: why the US stock market? The US stock market has long been considered one of the most attractive in the world, and here's why. 1. The world's largest economy, the United States, is the #1 economy on the planet. It's home to companies like Apple, Microsoft, Amazon, Tesla, Google, and Meta. When you buy shares of these companies, you become a shareholder, literally owning a piece of these global giants shaping the future. 2. Transparency and regulation. Public companies in the US must release quarterly earnings reports and follow strict SEC regulations. That transparency gives investors confidence and helps you make decisions based on facts, not just guesses. 3. High liquidity. Every single day, trillions of dollars are traded in US markets. That means you can buy or sell stocks almost instantly, without worrying about being stuck. For attractive long-term returns, historically, the S&P 500, which represents the 500 largest companies in America, has returned an average of about 10% per year over the past century. Combine that with compound interest, and small investments can grow into life-changing wealth. Part 2: Can you really start with a small amount? A lot of people still think investing requires big money. They imagine you need thousands of dollars just to buy one share of Amazon or Tesla. That was true in the past, but today the story is completely different. 1. Fractional shares. Thanks to fractional investing, you can now buy part of a share. For example, Tesla trades at $250 per share. But with just $25, you can own 0.1 shares. You don't need to wait until you have $250, you can start immediately. 2. No trading fees. Most US brokers like Robinhood, Fidelity, Charles Schwab, and TD Ameritrade now offer zero commission trades. In the past, high fees made it hard for small investors, but not anymore. 3. Start with as little as $1. Many apps allow you to invest with just $1. Yes, $1 less than a fast food meal is enough to begin your journey toward financial freedom. In other words, the barrier to entry is basically gone. The only thing holding you back is the mindset of "I don't have enough money." Part 3: Preparing. Before you invest, before you buy your first stock, you need a solid foundation. There are 4 important steps. 1. Define your goals. Long-term, 10-30 years, focus on ETFs or index funds. Medium-term, 3-10 years, combine ETFs with a few individual stocks. Short-term, less than 3 years, the stock market is not ideal, it's too risky. 2. Understand basic concepts. Stock equals ownership of a piece of a company. ETF equals a basket of stocks, giving instant diversification. Dividend equals profit shared with shareholders. And always remember, higher returns mean higher risks. 3. Choose a brokerage. Popular names in the US include Fidelity, Charles Schwab, Robinhood, E*TRADE, and TD Ameritrade. 4. Adopt the right mindset. Stock investing is not a get-rich-quick scheme. There will be ups and downs. The secret is not predicting the market, but staying patient and disciplined. Part 4: How to invest with little money. Now let's get practical. If you only have a small amount of capital, here are the main strategies. 1. Buy fractional shares. Example: Tesla is $250 per share, but with $25 you can still own 0.1 shares. Pros: anyone can participate, easy diversification. Cons: temptation to chase hot stocks. 2. Invest in ETFs. A smarter, safer choice is ETFs. Instead of betting on one company, you buy a basket of many. SPY or VOO tracks the S&P 500. QQQ focused on tech stocks. SCHD dividend focused. 3. Dollar cost averaging, DCA. Invest a fixed amount regularly, e.g., $50 per month. Whether the market goes up or down, you keep buying. This removes the stress of timing the market and reduces risk. For mix and match example, you invest $100 per month, $70 goes to an S&P 500 ETF, $30 goes to individual stocks you believe in. Part 5: The Power of Compound Interest. Albert Einstein once called compound interest the eighth wonder of the world. Let's see why. Invest $100 per month in the S&P 500, 10% average return after 10 years about $19,000. After 20 years about $68,000. After 30 years about $226,000. Increase it to $500 per month, after 30 years over $1.1 million. The lesson? You don't need to start big. You just need to start early and stay consistent. Part 6: Common mistakes to avoid. Here are some of the biggest traps new investors fall into. 1. Chasing trends, buying stocks just because they're hot on TikTok or Reddit. 2. Putting all money into one stock, extremely risky if the company fails. 3. Panic selling during crashes, forgetting that markets always move in cycles. 4. Investing without a plan, like driving without a map. 5. Using money you can't afford to lose, never invest rent money, tuition, or daily expenses. Part 7: Advanced strategies for small investors. Once you've got the basics down, here are some advanced techniques. 1. Drip dividend reinvestment plans. Instead of taking dividends as cash, reinvest them automatically to buy more shares. 2. 50/30/20 budgeting rule. 50% of income essentials, 30% wants, 20% savings and investments. 3. Investment journal. Write down why you bought a stock, track results, and review later. This helps you avoid emotional decisions. Part 8: Psychology of investing. The hardest part of investing isn't picking stocks, it's controlling your emotions. 2008 financial crisis, the S&P 500 dropped over 50%. Those who panic sold lost everything. Those who held on recovered and made huge profits later. 2020 COVID crash, the market plunged 35% in weeks. Many sold in fear. But just 1 year later, markets hit new highs. Lesson: the market always recovers in the long run. Your biggest enemy isn't the market, it's fear and impatience. Part 9: Financial habits. To build capital to invest, you need money. To have money, you need good habits. 1. Track your expenses, find the leaks. 2. Use the 24-hour rule, delay impulse purchases. 3. Automate, set up automatic transfers into your investment account. 4. Increase your income, side hustles, freelancing, small businesses. 5. Reinvest your profits, let money keep working for you. Part 10: Real story, John's $50 journey. Meet John. At 22, he started investing just $50 per month into an S&P 500 ETF. At 32, about $9,500. At 42, about $34,000. At 52, over $118,000. Meanwhile, his friend Mark decided to wait until he had more money. Mark started at 35, contributing $100 per month, double John's amount. But by age 52, John still had more money than Mark, simply because John started earlier. The takeaway: starting early is more important than starting big. Time is your most valuable asset. Part 11: Conclusion plus call to action. So, to wrap this up, you don't need a lot of money to invest. Fractional shares and ETFs let you start with just a few dollars. Discipline, patience, and consistency are the real keys to success. The earlier you start, the bigger the benefits of compound interest. Here's your challenge: open a brokerage app today, create an account, and invest at least $10. It doesn't matter if it's a stock or an ETF, what matters is building the habit. Remember this: the best time to invest was yesterday. The second best time is today. Don't let your future self regret the decisions you didn't make today. If you found this video helpful, hit the like button, subscribe for more investing tips, and share this video with your friends so they can start their journey too.